35 cents per mile. That is what a robotaxi ride costs in China right now. In the United States, the same trip with Waymo costs $2 per mile. That is a nearly 6-to-1 cost advantage, and it is about to reshape urban transportation on every continent.
Welcome back to Asia Tech Macro. I'm Maya, and today we're covering what might be the most underreported technology story of 2026. Chinese autonomous driving companies are not just testing self-driving cars anymore. They are operating commercial robotaxi fleets in over 50 cities, expanding into the Middle East, Europe, and Southeast Asia, and reaching profitability milestones that Waymo and Tesla haven't. And the numbers are staggering.
Let me lay out the three companies driving this revolution. First, Pony.ai. They had 1,446 robotaxis on the road as of March 25th and are targeting over 3,000 by year-end. Their Q4 2025 robotaxi revenue was up 160% year-over-year, with fare charging revenue surging more than 500%. They're delivering 26 rides per car per day, which translates to more than 25,000 daily rides total. And here's the headline. Pony's Gen 7 robotaxi, mass-produced through a strategic partnership with Toyota, has achieved citywide unit economics break-even.
Wait, unit economics break-even? That's the holy grail of robotaxis. Waymo has been operating for over a decade, and they haven't publicly claimed that.
That's exactly right. And Pony isn't alone. Baidu's Apollo Go just hit 300,000 weekly paid rides as of February 2026, operating across 22 cities with over 17 million cumulative rides. They've achieved per-vehicle profitability in Wuhan, their largest deployment. Wuhan is essentially the proving ground. Over 1,000 vehicles covering 3,000 square kilometers, including highways at 70 to 80 kilometers per hour. Robin Li, Baidu CEO, has been targeting full divisional profitability, not just per vehicle, for their autonomous driving unit.
And then there's WeRide, right?
WeRide is the third leg of this Chinese robotaxi triad. They IPO'd on NASDAQ in October 2025, becoming the world's first publicly traded robotaxi company, valued at 5.3 billion hours. Their fleet target for 2026 is 2,600 vehicles, with a longer-term goal of tens of thousands by 2030. But what really sets WeRide apart is their global footprint. They're operating in over 30 cities across 11 countries. And at GTC 2026 in March, they unveiled a next-generation robotaxi powered by NVIDIA's Drive Hyperion platform, the GXR, with plans to deploy 2,000 units by year-end.
So we have three Chinese companies with fleets in the thousands, reaching profitability milestones and expanding globally. This is fundamentally different from even 2 years ago, when Chinese autonomous driving was mostly a domestic story.
The global expansion is the real story here, and the beachhead is the Middle East. Baidu's Apollo Go partnered with Dubai's Roads and Transportation Authority to deploy 100 fully autonomous robotaxis, scaling to 1,000 by 2028. WeRide partnered with Uber to launch the Middle East's first fully driverless commercial robotaxi service in Abu Dhabi in November 2025. No safety driver in the vehicle. They received the world's first city-level fully driverless robotaxi permit outside the United States.
No safety driver? That's level 4 autonomy and commercial operation in a foreign country. That's a massive milestone.
And the Abu Dhabi permit is critical because removing the safety officer is what enables unit economics break-even. The human driver is the single largest cost component in ride-hailing. Eliminate that, and the math changes completely. WeRide's Abu Dhabi fleet achieved economics break-even specifically because of the driverless permit.
I was reading that Pony.ai is also planning a fully autonomous commercial robotaxi business in Dubai, and they're looking at expanding into Europe and Singapore as well.
That's correct. Pony has operations planned or underway in the UAE, Qatar, and Singapore. Baidu is even more ambitious on the European front. They're partnering with Postbus in Switzerland and Lyft in Germany and the United Kingdom. Apollo Go is planning to launch autonomous vehicle pilot programs in London during the first half of 2026. London. That's not a test market. That's one of the world's most complex driving environments.
Let's dig into why Chinese robotaxis are so much cheaper. Because the 35 cents versus $2 per mile difference isn't just about labor costs. There's a structural advantage here.
You're right, and this is the part most Western analysts underappreciate. According to ARK Invest's 2025 analysis, the cost advantage comes from three interconnected factors. First, China's auto industry offers globally competitive vehicle prices thanks to government subsidies, a comprehensive supply chain, and lower manufacturing costs. Pony's Gen 7 robotaxi, co-developed with Toyota, benefits from this ecosystem. The base vehicle cost is a fraction of what Waymo pays for its Jaguar I-Pace fleet.
What's the approximate vehicle cost difference?
Estimates vary, but the general consensus is that a fully equipped Chinese robotaxi costs between 200,000 and 300,000 RMB, roughly $28,000 to $42,000. A Waymo vehicle, including the custom Jaguar I-Pace and its sensor suite, reportedly costs over $200,000. That's a 5 to 7 times hardware cost advantage before you even start counting rides.
And the sensors are comparable?
They're converging rapidly. Chinese robotaxi companies use LiDAR, cameras, and radar, similar to Waymo. But Chinese LiDAR manufacturers like Hesai and RoboSense have driven sensor costs down dramatically through mass production. Hesai went public on NASDAQ and has been shipping automotive-grade LiDAR at prices that would have been unthinkable 3 years ago. The Chinese supply chain advantage in AI chips, LiDAR, cameras, and vehicle manufacturing creates a structural moat that's very difficult for Western competitors to replicate.
Okay, but here's the competitive landscape question. Waymo just hit 500,000 weekly paid rides across 10 U.S. cities. They doubled their weekly ridership in under a year. They're clearly winning in America. And Tesla finally launched its robotaxi service in Austin in June 2025. So how do you compare the U.S. and Chinese approaches?
Great question, and the answer is that they're fighting different wars. Waymo dominates the US market with the most mature technology stack and the deepest safety record. They've driven over 30 million fully autonomous miles. But Waymo's expansion is slow and expensive. Each new city requires months of mapping and testing. Tesla's approach is fundamentally different. They're using a vision-only system, no LiDAR, with a fleet of consumer cars that collect data as they drive. Tesla's Austin launch was significant, but their regulatory path is uncertain, and their technology hasn't proven level 4 reliability at scale.
And where does Tesla stand in Asia?
This is the critical point. Tesla is effectively locked out of the Chinese robotaxi market. Data export restrictions prohibit Tesla from transferring driving data collected by its vehicles in China back to its data centers in the US. Without that data pipeline, Tesla cannot train or improve its autonomous driving models for Chinese road conditions. It's a structural regulatory barrier that essentially hands the Chinese market to domestic players.
That reminds me of what happened with Google and Facebook in China. Regulatory barriers created protected space for domestic champions to emerge.
Exactly the same dynamic. And just like Baidu became China's Google and WeChat became China's WhatsApp, we're now seeing Pony, Baidu Apollo, and WeRide become China's Waymo, but with one crucial difference. These companies aren't staying inside China's borders. They're going global in a way that Baidu and Tencent never did with their core products.
The Middle East strategy is fascinating. Why the Gulf specifically?
Several factors. Gulf states, particularly the UAE and Saudi Arabia, have explicitly welcomed Chinese autonomous driving companies as part of their economic diversification strategies. Abu Dhabi granted WeRide the world's first city-level fully driverless permit outside the US. That's a regulatory fast track that would take years in Europe or the US. The Gulf also has favorable driving conditions, wide roads, minimal precipitation, predictable traffic patterns. It's an ideal testing and scaling environment. And there's a geopolitical dimension. Gulf states are deliberately cultivating technology partnerships with China as a counterbalance to their traditional Western alliances.
So the Gulf is essentially a launchpad for Chinese autonomous driving companies to build international track records before tackling harder markets like Europe.
Precisely. And that track record matters enormously for regulatory approval in places like London, Berlin, and Singapore. When Baidu applies for a robotaxi permit in London, they can point to billions of miles driven and millions of commercial rides completed across multiple countries. That's a regulatory argument that's very hard to dismiss.
Contrarian corner time. The consensus view is pretty bullish on Chinese robotaxis. Unit economics break even, global expansion into the Gulf and Europe, massive cost advantages over Waymo and Tesla, and Goldman Sachs projecting a $105 billion global market by 2035. Alex, what could go wrong?
The contrarian position starts with a regulatory reality check. China itself just pumped the brakes on its own autonomous driving ambitions. A fatal accident involving a Xiaomi SU7 earlier this year led regulators to pause issuing Level 3 permits until further safety rules for advanced driver assistance systems are finalized. Now, Level 3 and Level 4 are different categories, but the incident reveals something important. China's regulatory environment, which has been remarkably permissive for robotaxis, could tighten significantly with a single high-profile accident.
That's a good point. One fatal accident in a robotaxi could set the entire industry back years.
And the probability of incidents increases exponentially with scale. When you have a few hundred vehicles in controlled environments, accidents are rare. When you have 3,000 Pony robotaxis and 1,000 Apollo Go vehicles operating simultaneously across 22 cities, the statistical likelihood of a serious accident is much higher. Waymo has dealt with this in the US. Their vehicles have been involved in multiple incidents, including collisions with emergency vehicles, and each one triggers public scrutiny and regulatory review.
Okay, but devil's advocate on the devil's advocate. Autonomous vehicles are still statistically safer than human drivers.
They are, on average, but public perception doesn't follow averages. It follows headlines. And here's the deeper contrarian concern that I think most people are missing. The global expansion story assumes that Chinese companies can maintain their technology edge and cost advantages in foreign markets. But consider this. When WeRide operates in Abu Dhabi with Uber, they're subject to UAE data governance regulations. When Baidu launches in London, they'll be subject to UK data protection laws and potentially the EU AI Act's provisions on high-risk AI systems. Every country they enter adds a new regulatory compliance layer, and compliance costs money.
The EU AI Act is particularly relevant here. Autonomous vehicles are classified as high-risk AI systems under the Act.
Right? The EU AI Act will be fully enforceable by August 2026, with penalties of up to 35 million euros, or 7% of global revenue. Chinese robotaxi companies entering Europe will be to demonstrate conformity assessment, maintain detailed technical documentation, implement human oversight mechanisms, and ensure transparency about their AI systems' decision-making processes. This is a fundamentally different regulatory environment than China or the Gulf.
So the cost advantage at the vehicle level could be partially offset by the compliance costs of operating in regulated Western markets.
That's exactly the risk. And there's a geopolitical overlay that we shouldn't ignore. Chinese autonomous driving companies collect enormous amounts of data about road infrastructure, traffic patterns, and urban geography in every city they operate. Western security establishments are already nervous about Chinese surveillance technology. Imagine the political reaction when a fleet of Chinese robotaxis with LiDAR and cameras is mapping the streets of London in real time.
That is going to be a spicy political debate.
It already is, quietly. The same arguments that were used against Huawei's 5G equipment, that Chinese technology companies could be compelled by Beijing to share data under China's national security laws, will inevitably be applied to Chinese robotaxi companies. TikTok went through this exact cycle. First enthusiastic adoption, then security concerns, then regulatory action.
So you're saying the TikTok playbook could repeat for Chinese robotaxis?
I'm saying the conditions exist for it, and the regulatory response could fragment the global robotaxi market the same way the internet was fragmented into Chinese and Western ecosystems. Chinese companies dominate at home and in the Gulf. Western companies dominate in the US and EU, and countries in between, India, Southeast Asia, Latin America, become contested territory.
That fragmentation scenario is actually really interesting because it mirrors what we've been discussing with semiconductors, two parallel ecosystems.
The pattern is consistent across technology sectors: AI chips, cloud computing, social media, and now autonomous driving. Every technology that collects data at scale and touches critical infrastructure is subject to geopolitical bifurcation. The question is whether robotaxis cross the sensitivity threshold that triggers regulatory pushback in the West.
Action items time. Given the scale of China's robotaxi expansion, the cost advantages, and the regulatory risks, what should investors and business professionals be tracking?
3 specific actions. First, track Pony.ai's fleet deployment numbers against their 3,000 vehicle target by year-end 2026. Pony is the purest play on the Chinese robotaxi export thesis. They had 1,446 vehicles as of March 25th, meaning they need to more than double in 9 months. The key metric isn't just total vehicles, it's revenue per vehicle per day. At 26 rides per car per day, Pony is running at utilization rates that rival traditional ride-hailing. If that number climbs to 30 or more while maintaining the cost structure, the unit economics story becomes undeniable. Watch their quarterly earnings for commentary on Gen 7 deployment pace and any new international market announcements. Their NASDAQ-listed Pony stock is currently rated strong buy by analysts with a 12-month target of $22, a 54% upside from recent levels.
Second,
monitor the regulatory pipeline in Europe, specifically the London pilot and EU AI Act enforcement. Baidu's Apollo Go is planning London operations in the first half of 2026. This is the highest profile test of whether Chinese autonomous driving technology can operate in a heavily regulated Western market. The UK's Autonomous Vehicles Act 2024 provides a legal framework for self-driving vehicles, but the implementation details are still being worked out. If London grants Baidu a commercial pilot license, it opens the door for all Chinese robotaxi companies in Europe. If London blocks or significantly delays the pilot, it signals that geopolitical concerns will limit Chinese autonomous driving to friendly markets. Track UK Department for Transport announcements and any commentary from London's Transport for London Authority.
and third,
Third, and this is the one with the longest time horizon,
build a framework to evaluate the 1.9 million robotaxi projection for China by 2035. Goldman Sachs projects the global robotaxi market at $105 billion by 2035, with 934,000 vehicles globally. China alone projects 1.9 million robotaxis by that date, which would represent roughly two-thirds of the global fleet. The key enabling metric is regulatory expansion. Right now, 50 Chinese cities allow autonomous driving testing, and 10 allow commercial operations. If that 10 expands to 30 or more by end of 2027, the 1.9 million target becomes plausible. If it stalls at 15 to 20 cities due to safety incidents or regulatory caution, the timeline pushes out significantly. Track China's Ministry of Industry and Information Technology announcements on autonomous driving city approvals.
The big takeaway I'm getting is that Chinese robotaxis have crossed a threshold that most people outside the industry haven't noticed. This isn't a research project anymore. It's a commercial business with real revenue, real profitability, and a real global expansion strategy.
That's the key insight. While Western media obsesses over Tesla's robotaxi promises and Waymo's U.S. expansion, Chinese companies have quietly built the world's largest autonomous driving fleets, achieved economics that work, and are exporting the technology to every continent. The 35-cent per mile cost structure is a structural advantage that compounds over time. Whether it translates into global dominance or gets constrained by geopolitical fragmentation is the defining question for the next 5 years.
And if you want the written version with all the data, the fleet comparisons, the cost breakdowns, and the regulatory timeline, we publish a free daily newsletter at asiatechmacro.substack.com.
Coming up next, we're going to look at how the Middle East sovereign wealth funds, Abu Dhabi's ADQ, Saudi Arabia's PIF, and Qatar Investment Authority are becoming the new kingmakers in Asian technology. From Chinese robotaxis to Indian startups to Southeast Asian fintech, Gulf Capital is reshaping who wins and who loses. The numbers are going to surprise you.
That's going to be a great one. Thanks for listening, everyone.
Stay data-driven